During times of market volatility, 73% of retail investors maintain their existing investment strategy or use it as an opportunity to buy more investments, while only 8% react by selling off their investments. That's according to a new study from trading and investing platform eToro. Joining me now is Brent Kenwell, eToro U.S. investment analyst. So that all may be the playbook normally, but today is not a normal day, Brett. And so I'm curious if even on a day like this, you see retail investors buying the dip.
Yeah, so when we did this survey, just for context, the dates were, we did it between February 18th and March 4th. So it really caught, the high in the S&P and then, those really kind of the first half of the correction. And, to me, it came back as surprisingly optimistic, surprisingly positive, certainly stronger than I thought. But I do imagine that sentiment has taken a little bit of a hit in the recent weeks. Just as like everything else has kind of come in and come under pressure, we see confidence continue to move lower. We see investor sentiment continue to move lower. So I wouldn't be surprised if retail hasn't been able to buck that trend as well. But it's going to really depend on how things shake out going forward from here, whether that's related to the tariffs or more importantly, as it relates to the economy as we kind of sort through Q2 and push into the second half of the year.
And Brett, what do we tend to see at times like this when things get even more volatile? And what kind of action do you tend to see and are you seeing on the platform?
Well, as it relates to retail investors in general, I think at first they have a tendency to really embrace the dip. Going back into this survey, we asked specifically about holding periods and how long investors, what their time frame generally is. And a majority were in either measuring between years or decades. So this tends to be a group that looks a little bit longer term. And when we're kind of dealing with that, in the context of time frame, it's easier to deal with these sort of periods, even though this is a hard, period to navigate with volatility, emotions are high. When your outlook is in the years instead of weeks or months, it's a lot easier to embrace a 5 or 10% correction. If we get into that 15, 20% correction, tiptoe into a bear market, then I think, it does get a little harder to embrace those dips. We saw retail appetite for the dip pretty strong January, February, but I think that appetite has waned a little bit, as has patience and as has certainty, really over these last 4 weeks or so.
And what about when it comes to big cap tech, which has been the thing that has been, probably what retail and institutional investors alike have been most enthusiastic about, the AI trade, et cetera. Is seeing any wavering there?
Interestingly, I personally think that a lot of the sentiment declines in market-wide sentiment are tied to tech. When you look through dig through the Q1 results, the performance results of the S&P sectors, a majority of them did pretty well. The weakness was really tied to consumer discretionary and tech, which, in this case, unfortunately, accounts for more than 40% of the S&P 500. So a bulk of the sectors actually outperformed the index itself, but that weakness in tech really weighed things down. Now, what's surprising from the survey is how sentiment didn't really waver from, quarter over quarter. Confidence in Magnificent Seven stayed the same. 48% of respondents expect the Mag 7 to outperform the S&P this year. Confidence in AI stocks actually went up quarter over quarter, which again, so when we did this survey, it was after the DeepSeek news, after the volatility in AI, it was once tariffs were on the table. So to not really see the confidence waver in mega cap tech or in AI was surprising to me.
And did you see any changes from sort of different demographics on the platform?
Yes, Gen Z wasn't an asset class, it was a generation, and it was Gen Z. They really, I think from the survey results, they seem to have really kind of handled the moves in the market really well over the last 6 months. So when we last did this survey, again, for context, the prior survey was done between late November and early December. And we saw this really risk-off rotation from Gen Z. So they were rotating into cash, rotating into bonds, which was, surprised me because it's a younger generation. They tend to have a larger risk appetite and be more risk on. Fast forward to this quarter, now we're seeing all that rotation come back out of cash. They went from 75% of respondents saying they had a cash position down to just 60%, but big increases across the board, whether it's in crypto, domestic stocks, foreign stocks, commodities, which our read-through was silver and gold in that scenario. But really kind of embracing all sorts of different asset classes and sectors, which is in a way it looks like they took advantage of the big run up in Q4 and are trying to take advantage of the dip in Q1.